Hi, today we're going to be talking about timeframes. So although this might not seem like the most exciting topic, it is a key skill for Forex traders. It involves reading charts and developing strategies to anticipate market movements for profit. A time frame is basically a period of time where a price movement takes place. It could be anywhere from a few seconds to a few minutes to a few hours, days, or weeks. So if you're tracking your assets across minutes, it means that your time frame is set in the minute time frame. As you can see on my screen, here are the most common time frames. So there are 1 minute time frames, 15 minute, 30 minute, hourly, 4 hourly, daily, weekly, and monthly. Using timeframes is essential in analyzing the strength of the trend of the price movement of that asset. And this is to establish if there are any notable trends over the time frame that you have chosen. Traders often ask which is the best time frame for trading, and as with everything, it depends. If you are trading stocks, for example, it might differ from the best time to trade Forex pairs. So this also depends on the trading strategy you use. If you are a positional trader, you will be holding trades for much longer periods of time, say days, weeks, or months, while scalpers, who are in and out of the trades very quickly all day, will use much shorter time frames. In contrast, day traders who don't hold positions overnight will be in and out of trades multiple times during the day, and so they may use the daily or hourly time frames. The time frame you choose also depends on your personality and availability. Do you like to take things slow and think about your trades and look at the trends very carefully, or do you like a fast, action-packed pace of trading? Another factor to consider when choosing a time frame for trading is how much capital you have. Positional traders will often have to put in a lot more capital to withstand the market movements when they're trading, while shorter term or scalpers will be able to put in much smaller amounts of capital with higher leverage because they can manage their risk easier because they're looking at their trades all day. Positional traders will also not have to pay as many fees on spreads and commissions because they hold their position for longer periods, while scalpers who are in and out of positions all day will have to pay the spread and or the commission when they're trading. But the difference is that positional traders will have to pay overnight financing fees or swap fees, especially if they're using leverage, while scalpers will not have to pay these fees. If we look at the different trading strategies, scalpers use much shorter time frames. They're in and out of trades every 1 to 15 minutes, and the most commonly used time frame by scalpers is the 1 to 2 minute time frame. The best time frames for day traders tend to be the 15-minute time frames. Day traders tend to look at their trends over 60-minute time frames to establish longer-term trends, and then use the 15-minute time frame to establish the shorter-term trends. So position traders obviously hold their assets for much longer periods of time. Therefore, they often look at time frames that span weeks or days, depending on what they're holding and how long they wish to hold it. Most traders use multiple time frame analysis to determine the price entry and exit points. It involves looking at assets across multiple time frames to determine the best trading opportunities of that asset. Most traders choose one longer time frame and one shorter time frame, and the ratio is often 1 to 4. So if you're looking at the 4 and 6 hourly charts as your longer time frames, then your short time frame will be the 1 hour charts. The longer time frames are used to establish the trend, while the shorter time frames will be used to determine the entry and exit points of that trade. And the beauty of this approach is that technical analysis is used in both time frames to create a greater conviction for that trade. How do you perform multi-timeframe analysis? So if you're a day trader, you will start out by looking at the weekly charts, and it'll give you a broad overview of the asset and the market direction that that asset is taking. On the weekly time frame, you'll look at the support and resistance levels, and you'll look at the swing highs and swing lows and mark these on your chart. You'll spend a bit more time on the daily charts. So here you will look at also the support and resistance levels, and you'll also mark the swing highs and swing lows. The daily charts will help you determine your actual trade areas. So even if you don't use the support and resistance lines and the swing highs and swing lows that you marked on your chart, you will still use these to determine the basic trend of your asset. Once you perform the daily and the weekly analysis, you'll move on to the 4 hour and 1 hour for your execution of your trades. So on the 4 hourly time frame, you'll map out your trade scenarios and the specific trades that you will take. You will take the ideas that you had from your weekly and daily time frames and translate these into actionable trading ideas. You should always create long and short-term trade scenarios. This will keep you open-minded, and it'll also keep you free from any bias when placing your trades. Thanks for watching. If you have any questions, please send them through to us. We are very happy to answer any of your trading related questions.